For those of you who are joining us for the first time, my name is Brandy Garza. I'm the CEO and founder of COR Bookkeeping and Consulting. We are a small bookkeeping firm here in Austin, Texas, and I'm coming to you live today to go over a few topics that I feel like every small business owner needs to know. So we're going to go ahead and get started. All right, so the first questions that we're going to address, we're going to talk about the difference between the different types of professionals that are available to you as a business owner to contract with or to work with to take care of the finances of your small business. So the first one that we're going to talk about, the first group of professionals we're going to talk about are your tax folks, because those are the ones that everybody everyone knows about. Everyone has, traditionally heard about these folks. You've probably worked with CPAs before, tax preparers, lots of different names nowadays that they go by. The most common ones are the ones that you should really look for, the designations you should look for when you're looking for somebody to help you prepare your taxes. Should be a CPA, an EA, or a CTP, right? So you're looking for those three acronyms. The different designations do mean they're certified in different ways. So a CTP is a certified tax professional. These folks are typically certified by independent organizations, different schools that train these folks, teach them how to utilize different softwares, teach them the basics of typically individual tax preparation. You don't really go too much into the business tax preparation. CTPs you're going to find more at your Jackson Hewitts, your H&R Blocks. Those folks are typically going to be where your CTPs are found, and you do find them also working in CPA firms and with EAs as well, just because they can assist with getting those tax returns done for the clients. CPAs are certified by the state in which they practice. So wherever their practice is located, that's where their certification comes from, right? The other designation is an EA, enrolled agent. EAs are certified by the IRS. So, they're tested on the book and the quality of rule that the IRS goes by to make sure tax returns are done properly. One of the biggest difference between an EA and a CPA is that EAs are certified to practice nationwide, whereas CPAs can only certified to practice within the state that their practice is located. So that's really the biggest difference between the two. As far as knowledge base and ability, my experience, they're both great. They're wealth of knowledge in both all of those arenas, tax preparers, CPAs, and EAs. But you definitely want to look at those. You want to look for those designations of the team that is going to be working to prepare your tax returns. You want to make sure they have those folks all available. Typically, those professions specialize in tax and financial accounting. And I get a lot of people that ask me the question, what does that mean? What is the difference between, tax, financial accounting, and, regular accounting for my business? That's always a question that I'm asked quite a bit. Financial accounting and tax are very different from what you need day-to-day to run a business. The tax and financial accounting is important because, obviously that controls your tax liability when you owe the IRS, and we want to make sure that those things we're using, certified professionals, and that, those numbers are right, because that's going to affect the amount of money that you are going to have to pay out to the IRS, right? So you want to make sure those numbers are correct. As far as, on a day-to-day basis, you're looking for someone that has a little bit of a different skill set, a little bit of a different everyday practice. You're looking for a bookkeeper, an accountant, a certified managerial accountant, somebody who really understands how to interpret and analyze financials, and that can help you understand what's happening in your business. Where are you making money? Where are you losing money? All of those designations, bookkeepers, accountants, CMAs, they're certified by different agencies to receive their designation. They're typically highly skilled in revenue operations, and everyone's like, well, what does that mean, revenue operations? So revenue operations is really the thing that's the financial side of your business that is actually actively working all the time, right? It's your services going out. It's the money coming in from those services, and it's the money going back out to pay all the bills associated with them. It's managing all of your overhead to make sure that you're staying in line with with what your pricing structure looks like, and keeping an eye on those different types of costs and that different set of financials when you think about accounting. That's what's really going to help you to be proactive versus reactive. A lot of folks don't look at their financials thoroughly until it comes time to prepare taxes, and that's fine. You can run your business that way. It might be kind of difficult because you're not going to be able to be proactive when it comes to making changes within your business, so that you don't get to a point where you are, dealing with some major losses in your company. So it's really important to have a really strong accounting team that's with you throughout the year. Whether that means that you have your own internal person who's managing that piece for you, you contract a firm like us who specialize in revenue operations. That's really what our specialty is. Or you have your own internal, controller, certified managerial accountant. Someone along those lines that can help you to really understand on a day-to-day, week-to-week, month-to-month basis what's happening in your company. Because a lot of times some big downfalls of businesses can be, you can mitigate that through reviewing your financials and knowing where you stand, if you introduce a new product line into your business, you don't want to wait until the end of the year to find out, is this product line making money? If you implement a new marketing strategy into your business, you don't want to wait for a year and a half to figure out, is this thing making me money or not? You want to be able to see that and analyze it, on intervals that make sense for you, whether that's monthly, quarterly, semi-annually. You want to make sure you're able to go in and measure those things and look at them and see, is my investment here returning on what I need? Is this introduction of this new revenue stream returning what I need? And also keeping an eye on your overhead. That's a really big one, especially nowadays with the economy being the way that it is. I've seen overhead expenses, which are typically fixed costs. Like those are the costs that don't really, they're not supposed to fluctuate too much. They stay pretty consistent. But now with, interest rates being what they are, inflation becoming what it is, having a 2 to 5% increase in your overhead can really make a big difference on your bottom line. So it's important to be able to keep an eye on all of those things. And the best way to do that is, to one, make sure you get a good accounting system implemented. That's kind of the base. You want to make sure that you pick the accounting system, the field service management software that's right for your company, that can be with you for a period of time that you're comfortable with and that you can scale and grow with. You also want to make sure that you have someone that's assisting you with all of this. I think that as small business owners, the only people that go into business for themselves to do accounting work are people like me, right? Like other accountants, other CPAs, folks that go into, that want to be, construction companies, or that go into, want to be attorneys and have engineering firms. All of those folks, they don't, you don't go into business to have to track invoicing and financials and, cost of goods sold and expenses and overhead and debt service. You don't go into business to do those things. And so that's why it's important to have some kind of assistance, some kind of coaching available to you, so that you can make sure that your financials are correct, that they're reporting accurately, that when you have questions about what's going on with the financials, that there's someone there that can answer them for you and that can answer them and communicate with you in a way that is that you understand. That's one of the other really important things about your financial team that you really, every small business owner needs to assemble, is making sure you've got the right people that you feel comfortable, working with, that you have good communication with them, and I would say, definitely meet with multiples. If you don't have those folks, meet with multiple people. Everyone's personalities are different. Everybody's businesses are different. The way people like to see things done is different, and look around, look for the right people to help you, because that's really going to make a difference in how you're able as a business owner to manage and understand what's happening in your business and adjust and make changes so that you can reach your goals, whether it be annual goals, long-term goals, whatever that might look like for you. having that right team in place to assist you and to back you up and to be there to help you will make all the difference. So now that we've kind of gone over what the different tax professionals are, right, the different financial and accounting professionals are, we're going to dive into what exactly makes up these reports that are so important for all of us to be looking at, all the time. I'm sure you hear your tax folks talking about a profit and loss. You hear them talking about a balance sheet. And so, we're going to dive into what actually makes up those things and what does that mean. Okay, so now we're going to go over what actually makes up these reports, this profit and loss and balance sheet that, everybody hears about, but not everyone really understands, like, what's the point of it? What am I supposed to do with this? How does this help me understand my business? How does this help to tell the tale of, what's going on in my business? So we're going to go over the fundamentals of, what those reports mean, right? And so I think the very first thing, most important thing that we need to cover is, the purpose of a profit and loss and a balance sheet, right? So one thing very simple way to remember this is a profit and loss report is going to tell you about the activities that are happening in your business. That is the most important way to look at that report. I've got my QuickBooks Online demo account pulled up for you because this is the number one software that most small business owners start with, right? And so I wanted to make sure that not only did we talk about what these things mean, but that I could also show you through the software how to get to those reports. So what you're going to want to do is you're going to log in, you're going to come over to your navigation bar on the left-hand side. You're going to click on reports. Now, when you log into your QuickBooks, it doesn't look like this and it looks different. A change that you'll want to make is you're going to click on this little gear up here in the top right-hand corner, and there's this option here that says switch to business view. It says switch to business view now because I'm not in that view. But when you log in, this might be what you see. You may see these options here on the side. You may see this dashboard here, but this looks very different than what I was showing you before. And you can use this. If this is something that you're comfortable with, you like these options. You can absolutely stay with this. However, I prefer, and I usually teach most of my clients to utilize this accountant view screen, just because this is the screen and these are the options that your CPA, bookkeeper, accountants, this is what they're going to see. This is what they're going to use. And when you're trying to communicate with these folks, it helps if you're both looking at the same thing, if you're both looking at the same, dashboards when you're trying to work together. And so I always recommend my clients switch to this view. And then once you're here, again, you can go into the reports, you go into the report center, and typically most QuickBooks will default to these 3 reports as favorites. You can go through and anything else in here that you think might be relevant to your business, you can star it and it'll pull it up to the top. There's got a nice business snapshot available in it. And you can play with this and evolve this, as your business grows. Sometimes you may start with just this and then, decide you want to add some more sales reports in there. That may be really what you want to look at. How many estimates am I providing by my customers? What does my income by customer look like? How much, I have these 10 clients, and of these 10 clients, I do lots of work for them, but which client is making me the most money and which client am I not making as much money on? So this report center is a very powerful tool, and we'll do another class on how to best utilize this and leverage it for your specific industry a little bit later on. But today, like I said, we're going to stick with these reports, just the very fundamental of what you need to understand and be looking at as a business owner. So again, your profit and loss is going to be the report that is going to tell you what's happening in your business. It's going to tell you, are you being profitable? It's going to tell you, what your cost of goods look like, what your overhead expenses look like, and most importantly, what your net income is, right? So, and that's the number that almost every small business owner is going to want to look at, because that's the number that tells you how profitable are you being. It also tells you, what's going to pass through to your personal return and that you're going to be taxed on, right? And that's a whole nother topic that we'll cover as well in a later training, is what does that net income number actually stand for? Again, but going back to the fundamentals and basics, profit and loss, just think of it as the report that's going to tell you what is actually happening in your business. This is your activity report. This tells you about your activities. Your balance sheet Your balance sheet is going to tell you what your business owns, and it's going to tell you what your business also owes, right? So it's going to tell you, I'm sure you've heard the word assets before, right? And you've heard the term liabilities before, and you've probably heard the term equity before. So all of those things really talk about the actual value of your company. What is it really worth? What do we have in equipment, and what do we have in buildings and land and vehicles? All of those things add value to your company as a whole. Not talking about the activities of your business, but just talking about, the actual value of the, like if I wanted to sell my business today, your balance sheet is going to play a critical role in how your business is valued, just because that tells a prospective buyer, what do you actually own? What do you actually have? And we'll get into more depth of building out your balance sheet, accounts that you should be looking for on your balance sheet, valuations, and how to best do that. I've got a great group that I work with here in Austin, Principal Financial. Neil and Juan Carlos are great. They're so helpful, especially when it comes to helping business owners understand, what is the value of their company and what their options are for going forward, like to meeting their goals, whether it's legacy, handing that business off to someone else, to a family member, or at some point selling it. So just remember, this balance sheet is very critical in that part of it, and so you always want to make sure that you're looking at that as well. So what makes up a profit and loss and balance sheet? That's really what we're going to dig into today. When you are in your QuickBooks account, something that is good for you to look at and for you to make sure is structured properly when you first start your QuickBooks file is your chart of accounts. And how do you get to your chart of accounts, right? Because if you look at this, there's nothing here that really tells you, how to get to that. And so the easiest way to do that is to click on your gear, and then you're going to come over to the left-hand side. You notice under your company, you've got these different options here. You're going to choose chart of accounts. When you first log into this, it's going to give you a little screen that's going to say, do you want to take a peek under the hood of your QuickBooks? And that's really what this is. This is what's really driving the information that's going to show up on your reports. So it's very important that as a business owner that you speak into this, because this is how things are actually going to be tracked in your books. And building this out, creating it, making sure that it's specific to your business type is going to be really important for you to be able to see the information you need to see on the reports, the profit and loss and balance sheet, so that you can make decisions about what to do in your company. So the first thing we're going to look at is we're going to start with the balance sheet, because the balance sheet is actually what drives your P&L, right? So everything the things that are moving around in the balance sheet are actually going to drive some of the information that's going into that profit and loss. And so it's important that your balance sheet is accurate. And that's one thing that you always want to make sure of, is that because all of these accounts, even though they're telling you overall what your business is valued at, the activity that's happening in these accounts is pushing into that profit and loss. So if these accounts are not balanced and not reconciled properly, then your profit and loss is going to be wrong. So you've got to make sure that balance sheet is balanced, and that that you're all reconciled, and that everything that should be reported on there is on there. I see a lot of times where owners have credit cards or loan accounts, things like that are not on their balance sheet. It's very important that you make sure that all of your accounts are listed on there, so that way the activity that's in there is pushing onto the other reports that needs to go there. So, all right. So when you're looking at your balance sheet, the very top of the balance sheet is always going to go over your assets. You're always going to see that at the very top, and you're going to notice that this chart of accounts is structured in that way. Your balance sheet is always going to read from most liquid all the way down to least liquid. And when we talk about liquidity, that's really where we discuss, if I needed to go get cash tomorrow, where does that cash come from, right? Like if I needed to go to the bank and I say I need $20,000, the top line of your balance sheet is going to go over how liquid your business is. And so when we talk about bank accounts, obviously, that's going to be your most liquid asset that you're going to have, because if you need to go pull cash, you can go straight to your bank, withdraw it, and then you've got your cash in your hand. Everything else is going to be less liquid or less accessible from a cash perspective. Your accounts receivables is going to go over the amounts that people owe to you as a business owner, right? So like your invoicing, things of that nature, the accounts that you have on your books for clients, right? Sometimes we carry client accounts where they can charge to that account and then pay at the end of a specified period of time. So that's what this accounts receivables number is going to indicate. This is going to be the amount of money that's owed to you by your customers. Inventory assets are going to be the product that you have on hand, right? So this is going to be, if you're in retail sales, you're a B2C, it's going to be your product. It's going to be your cups and your, things that you sell to the public. The other component that goes into inventory, and this is really important, that I think a lot of people overlook, is your material, right? So material that you have on hand for projects, material that you have on hand to complete work that maybe you haven't received, work that you have for orders that you haven't received yet. Especially when we talk about manufacturing, this is a really critical number to have accurate on your books, because again, this adds value to your business. Loans to others, this is going to be like if you loan money out to, somebody, another, work colleague or to another business. That's really where I see this the most, is owners that have multiple entities. They want to track their intercompany receivables. They want to make sure they know, I have a restaurant and I have a construction company, and my restaurant has loaned my construction company $20,000 or vice versa, right? So that's how you would keep track of that, is in this loans to others account. Undeposited funds, this really ties into the revenue operations side of your business, but it's on your balance sheet. A lot of times you'll see this being used, especially if you do a lot of merchant transactions. You'll see balances in there for deposits in transit, especially if we're trying to close out books for a specified period of time. Just because we all know, if you take credit cards, you run the credit card today, but that doesn't mean you get the money today. Sometimes that means you don't get the money for 3 days, right? But we still need to account for that, because we got to make sure that, whatever system that you're recording payments in and your books match each other. And so that's where this payments to deposit or a deposited funds account comes into play. Prepaid expenses, that's going to be things that you pay in advance. So like, let's say I decide to pay a year's worth of rent in advance. We don't want to put all of that rent on the books in 1 month, because that's going to totally throw off your finances, right? We want to make sure that, we're allocating that expense of rent over the course of the entire year, so that way your month-over-month reports produce accurately. However, we've got to put that number somewhere, right? And so that would be in prepaid expenses. And why is that considered an asset? That's an asset because even though, because the company actually has already paid that stuff in advance. So it's kind of, that's an asset. That's going to add value to the business, because if I'm an owner coming in and I said, well, buyer coming in, and the owner has said to me, I've already paid, a year and a half worth of rent in advance. That's going to add value to the business, because as a buyer, I'm not going to have to pay that, and so that's where that comes into play. Uncategorized assets is just kind of a catch-all account that QuickBooks always automatically puts in here. It's for things that as bookkeepers and accountants, we're not exactly sure what they are, but we know that they probably need to be capitalized, and we use this account just to hold them until we can get with owners and figure out what exactly the purchases were. When you do go to do your taxes at the end of the year, any of these uncategorized assets, uncategorized expenses, any of those types of accounts should always be cleared out to zero. There shouldn't ever be money sitting in there. So just something to keep in mind when you're looking at your financials with your CPAs and bookkeepers, just making sure that that stuff is listed out, nice and organized and very clear as to what the different purchases were that you made. Buildings, pretty self-explanatory. If you own an office building, that's definitely going to add value to your business. And so that's a fixed asset. That's something that you're going to have for a while. Land, same thing. And then any long-term office equipment. These are other things that add value to your business. Again, when you capitalize things, I think that different, the general rule of thumb that you should use is if you paid more than $1,000 for it, you want to capitalize it. And then you write it off through depreciation over a period of time on your taxes. That's how that's typically done. But definitely get with your tax professionals, your CPA, your EA, your certified tax preparer, whoever's working on your taxes, and have a conversation with them about capitalized equipment, because there's lots of options and different ways that you can handle this through, the bookkeeping, through the tax, and you just want to make sure that you have a plan and how that's going to affect your P&L at the end of the year, because having a lot of capitalized assets on your balance sheet, is great for business purposes, but you also want to know, how is this going to impact my tax liability at the end of the year? So that's a good conversation for you to have with your tax professionals. Tools, machinery, and equipment, same thing. Fixed assets, things that you depreciate over time, and you take the deduction on on your tax return at the end of every year. Vehicles, same thing. Now, when it comes to your vehicles, something to always keep in mind about this, and again, this is another conversation that you want to have with your CPA or your tax professional, whoever's working on your taxes for you, even your bookkeeper, is how are the vehicle expenses going to be handled? You cannot take a vehicle expense, you cannot have a vehicle on your balance sheet and take mileage at the same time. So there's different rules like that apply to things. I know I have this conversation a lot with clients, like when, how can you take mileage or can you not take mileage? Should we take depreciation, or how do I write off the gas? How do I write off the oil changes? All those conversations, and the best way to do that strategically for your business, those conversations should be had with your bookkeeper and your CPA or tax preparer. So that way you can come up with a plan that everybody agrees on how the company vehicles are going to be handled. So I definitely recommend that, but the vehicles also are going to be on your fixed asset list. And so when we're looking at this, we talked about liquidity. We talked about things that are most liquid to the things that are least liquid. And when we talk about least liquid, it doesn't mean that they're not able to convert to cash. It just means that it's going to take a little bit more time for them to convert to cash. So that's something to also keep in mind. So moving on from now, whenever you're looking at your balance sheet, you're going to see a total of all of your assets whenever we're looking at that. And we'll look at the actual reports at another training. Today we're going to really just talk about what makes up these reports. The next thing that we're going to look at is the monies that you owe, or your liabilities. I'm sure you've heard that term before with your different tax preparers and tax professionals that you've worked with. So liabilities is money that your company owes to another company. So that's going to be the money that is owed, that your vendors, people that you owe money to, your material suppliers, your utility expenses, all those types of things are going to be reflected in the liability section of your balance sheet. So we think about, what are the things that we are going to have that are going to be the most, again, it goes from, most liquid to least liquid, right? The things that we're going to have to pay right away, and the things that we're going to pay a little bit later on, or pay over a longer period of time. That's usually how I look at this. It's like the things that are at the top are the things that I'm going to have to pay, sooner, and then the other things are the things that I'm going to have to pay, I'm not going to pay them off for a longer period of time. And so accounts payable, again, is, your vendors, folks that you owe money to, your bills. Customer prepayments, this is actually very important for a lot of companies out there, because I feel like more and more I see business owners, especially in the construction industry, the manufacturing industry, that are receiving deposits for work that they don't necessarily start for a long period of time, and that money is being reported as income on their profit and loss statement. So it's very important that you understand that if you take any type of deposit in your business, if you're a construction company, if you're a manufacturer, and you take any kind of upfront deposits for your business, that is not considered income until you have completed that work. And that goes back to the whole revenue recognition rules with, with the IRS. And so we'll have a much more in-depth conversation about what that means. When do you recognize revenue as a business owner? We'll talk about that at a later date. But just keep in mind that if you take money up front before you actually complete a job, that customer prepayments or, customer deposits, that should be a liability account that shows up on your balance sheet. And why is it a liability, right? Like, Brandy, why would that be a liability? Well, it's a liability because you haven't actually earned it yet. It's not really your money. It really still belongs to the customer until you have completed that work. Now, once you've completed the work, then it no longer is a liability and it becomes income, right? And we'll get into the income portion of things in just a moment, but it's important to just remember that rule of thumb that if you take deposits, make sure you have some kind of a customer deposits account on your liabilities on your balance sheet. Lines of credit is pretty self-explanatory. If you've got a line of credit for your business, You want to have that on your balance sheet. Sales tax to pay. If you collect sales tax, definitely need to have this account on there, just because sales tax is not income. It should never be mixed in with your income. If you do collect sales tax, I highly recommend that whatever interval you're reporting to the comptroller, that is the same interval that you utilize to close your books. Whether it be your bookkeeper or whoever is taking care of that part of your business. So if you're a quarterly sales tax report, filer, you need to make sure that your books are being closed every quarter, so that way you're reporting your sales tax correctly to the comptroller's office, because you don't want to under-report or over-report, because those numbers do need to match the tax returns that you file at the end of the year. So it's really critical that those numbers are accurate and correct. Not to say that if you do file something incorrectly, like, you can always go back and amend and change, but that's just another one of those things that you want to keep an eye on, especially when you get to the end of the year and you're, preparing your tax return, your federal tax return to go to the IRS, making sure that the income that was reported for your business to the IRS is the same amount of income or gross sales that was reported to the comptroller's office. So that way you can make sure that those numbers are matching, because if there's differences in those two numbers, then something is wrong and it needs to be fixed before all of that is finalized. Short-term business loans, pretty self-explanatory. Any kind of short-term loan that you may cash advance, anything like that you may take. Long-term business loans, those are usually for equipment purchases or vehicle purchases. That's going to be, I financed a car and I'm paying the loan through the business, and so that's where those are going to land. Mortgages, things of that nature. So that's really where we wrap up with liabilities. This varies and it's different for lots of different clients, lots of different businesses. It's not the same. None of this is ever the same for every single business. It should be, again, tailored and customized specifically to what you need to be seeing for your company, so that way you understand, what's going on as far as valuation, liquidity, availability of cash, and then also, how much money you owe, right? Because when you look at your balance sheet and you look at this liabilities section that encompasses all of these different accounts, this ultimately will tell you how much debt are you in, how much money do you owe, right? And that's an important number as a business owner to keep up with, because you don't ever want this to get out of control. You always want to make sure that you're taking these numbers into consideration when you're putting together your pricing structure, your budget. These are critical to be accurate and up to date, so that way you know what that debt service amount that's part of your pricing structure is, right? Because you can adjust that number. Sometimes it goes up, sometimes it goes down, just depending on what's going on in your company. But that's the way that you keep track of your debt service percentage of your pricing structures, making sure that these liability accounts are correct and that they're reporting accurately. All right, so we get into equity. This is broken out pretty standard in QuickBooks. It automatically creates a lot of these accounts for you. You can track different things in your owner's draw accounts. You'll notice that QuickBooks is plugging in some personal expenses here, federal taxes, owner retirement plans. And again, these are all equity. So what is equity, right? What does that mean? So equity is your share of the business. What do you own as the business owner? It takes into consideration investments that you have made. It takes into consideration money that you have drawn out of the business, and it takes into consideration your retained earnings, right? So whatever that net income number is, it's rolling over from year to year. That's where this retained earnings number is going to come into play. So that way what is my overall profitability for the company for the life of the company, right? So that's an important number for you to look at. On the other side of this, though, some of these other equity accounts that you're looking at up here, you may be thinking to yourself, well, I thought none of this was deductible. Well, none of these things are actually deductible. So none of your personal expenses, none of your individual taxes as a business owner, your owner retirement plans, your individual tax liabilities, for state, healthcare, health insurance, HSA contributions by owner, none of that is going to actually be deductible, but you do still want to track it, because your tax preparer is going to need this information. They're going to need to know what is this activity for the money that the business owner drew out of the business? Where did it go? Exactly what did it pay for? It's all considered draws. So when you're looking at on the business side of it, it's all going to be rolled up into this owner's draw account. But the tax preparer will need to know this other information so that they can help you when it comes to working on your individual tax return. So that's why it's important to make sure that, this stuff is being tracked correctly, really making sure that your bookkeeper and the CPA or whoever's handling your taxes are in communication, and that they are in agreement with what accounts need to be tracked in regards to the owner's draws. Making sure that those communications are happening so that everyone's got the information they need to streamline your tax services. All right, and so that's pretty much when we talk about equity, that pretty much wraps that section up. So overall, when we're thinking about the balance sheet, right, we're thinking about what makes up the balance sheet. What is that? Remember, just the most important things to remember is this is going to be the thing that is going to tell you what is your business actually worth. What is the cash situation for your business? What does that look like? What is the debt situation for your business? What does that look like? And from an even higher perspective, a higher level perspective, what is my business really worth? What have all this time and effort I've been putting into it? What are the fruits of that labor? What is that retained earnings number? How are we growing? Is that number going up every year, or is it going down every year? That's an important number for you to keep an eye on, just because, like I said, it will tell you, year over year, what has been the success of the business. All right, and so now we're going to get into the profit and loss. We're going to talk about the different accounts that are going to make up that report. And this piece of it is really where, having someone help you build this is going to benefit you, and it's going to help you immensely. Just because this is going to tell you as an owner what is happening in your company. What does the activity look like in your company? Are you, what is it? What is your profit margin before the overhead expenses are added into things? When you think about that, we're going to talk about gross margin a little bit. We're going to talk about the different revenue streams and how you track those within QuickBooks, right? Because that's going to be really important. I think almost every business out there has multiple revenue streams, whether it be commercial and residential, whether it be retail sales or in wholesale accounts. It can be different types of product that you sell. There's a million different ways that you can structure this. But just remember, when you're thinking about the different income accounts you want to see on your profit and loss, we don't want to list out every single product that you sell, just because that's not the purpose of the profit and loss report. The profit and loss is you want to kind of lump together all of the different types of products that you sell or the different types of services you provide. So just to kind of give you an example, if I am a construction company, right, and I do residential and I do commercial work and I do painting and drywall and carpentry for both of those businesses. On my profit and loss report, what I really want to track on there is commercial sales and residential sales, right? Those are the two major categories that I want to look at on there. Now the subcategories for that, the paint, the drywall, the carpentry, those types of reports you don't have to put that on your profit and loss. QuickBooks has a way of tracking the different types of services you provide, or the different types of products that you sell on a more like in-depth detail basis. So that there's other ways to get that information. We'll go into that more in another training. We'll talk about the different types of sales reports that you can get out of QuickBooks to help you better understand where the revenue in your company is coming from. But just remember, from a profit and loss standpoint, when you're thinking about what you want to see on that report, we want to be really high over the top of that. We don't want to look at the detail of it. We want to look at the big categories of it. So that way you have a general picture of what the different types of revenue that are coming into your business are. So the next thing that we'll want to look at is cost of goods sold, right? And I get a lot of questions on this, because some folks use it, some folks don't. And when we talk about cost of goods sold, really every single business and industry out there has a cost of goods sold account, right? A lot of times folks like attorneys and engineers, they don't really know that, well, is that really cost of goods sold or is it an expense, right? Well, it's kind of it's really both. If you have billable hours, if you have employees that bill hours straight to the client, then that really is the cost of goods of that providing that service, right? And that's really what cost of goods sold is. It's the costs that are associated with providing the services that generate this income. So without this, you're not going to be able to generate the income. And so that's when you think about cost of goods sold, that's really what this is. I've got this set up in here so that it's kind of leans a little bit more towards manufacturing and construction. So when you're looking at these accounts, that's really what this is. But again, when you think about what are the costs associated with me providing this service to my business, that's your cost of goods sold. Those are your cost of goods sold numbers, and you should really be tracking those just so that you can break apart the costs of providing the service versus the overhead expenses, which we're going to get into in just a moment. One thing that I will tell you that is pretty critical, especially like I say for the construction, manufacturing industry, is making sure that your wages are separated correctly. Your office wages, your operations managers, your bookkeepers, all of those folks should not be in your cost of goods sold services. Those are overhead expenses because their jobs, even though their jobs are critical to producing the revenue that comes from the company, their jobs they're going to be there providing those services whether or not this revenue is coming in, right? So your bookkeeper is going to be there because they got to account for all of these expenses. Your operations manager is going to be there because he's got to make sure that the building is functioning, that the machinery is working, right? So their services more roll into your overhead expenses and less into your cost of goods sold. When you think about cost of goods sold wages, it's the people that are directly generating this income. So like we talked about billable hours, we talked about labor dollars that you pay out to subcontractors, right? So we've got another one of those in here because subcontractors are typically the folks that are doing the work that provides this income. So making sure that these costs are all broken out correctly, and like I said, making sure that your wages are broken out on here, so that way you can easily see how much money it's costing you to provide these different services. Now, when we start talking about expenses. This is really where we start getting into your overhead, the expenses that your business incurs, no matter what is going on, whether you're out there providing services or not, right? So when you think about those, it's going to be your advertising and marketing. It's going to be your building and property rent, right? Because rent's not going to stop even if you're not providing the services. Rent continues. Business licenses or certifications that you may have to get. You're going to have to get those, regardless of what this income number looks like up here, because we've got to keep those intact in order for the business to be running. Commissions and fees, I personally put this up in cost of goods sold just because I think that it's, commissions aren't paid out unless there's income coming into the business, right? So to me, that's really a cost of providing the service, but it can also go down into your expenses category. Really, you want to make sure that your CPA or tax professional and your bookkeeper agree on how that's structured so that it's reported the way that, the taxes are going to be submitted. So that way everybody agrees on that. Contract labor. So this typically when you think about contract labor, this is really going to apply more towards like repairs and maintenance, a plumber, somebody coming in to fix something in your building, not necessarily subcontractor expenses or wages. This can also be office contract labor. Contributions to charities is going to be an overhead expense. Your employee benefits for your overhead staff, this is going to be an overhead expense. This entertainment with clients, so this is going to be, part of your advertising, marketing, promo budget. That's where that number is really going to come into play, and that's going to be an expense that you're going to incur regardless of how much work is pumping through the business, right? Because we're always working on business development. Let's see, general business expenses, bad debt, bank fees, continuing education, all these things are overhead expenses. Now, you might be asking yourself, okay, Brandy, so what's the difference between these overhead expenses and your cost of goods sold expenses? Where does this all, how does this all tie together? So when you think about cost of goods sold, these are the expenses that are going to fluctuate based off of the amount of income you're producing. So if these numbers go up, then your cost of goods sold numbers are going to go up, right? So there should be when you're looking at your financials month over month, the percentage of this number should be stable against what this income number is. So if your income number goes up, then this cost of goods sold total dollar amount should go up, but the percentage should stay the same. It shouldn't change. So that's just something to keep in mind whenever you're looking at these reports. Now, your fixed expenses, your overhead expenses, when you first start out, the percentage of your overhead expenses is probably going to be higher. It's going to be a higher percentage overall than your income is, because I think, when every business starts, you got to put a little bit of money into the advertising, you got to put a little bit of money into the infrastructure and the build out of your business, right? So this number from a percentage standpoint may be bigger at first, but once you get going, and the higher this income number is, the smaller percentage these overhead expense numbers should be, because these are fixed costs. These are budgetable costs. These are costs that as a business owner, you can control these costs. You can negotiate your rent. You can choose to rent a less expensive property. You can choose how much money you're going to spend in advertising and marketing. You can make decisions of what kind of benefits you're going to roll out to your employees, right? But these numbers, these dollars aren't going to change. They're going to stay the same. The percentage will fluctuate based off the amount of income that you're producing. So that's really where that all kind of ties together and how that works. We can also get into, so once we get to the bottom of your profit and loss statement, we've looked over all of your expenses, you're going to have a bottom line that's going to be your net income. Net income is the number that you're going to hear every tax preparer really talk to you about, because that's the number that's going to pass through to you, to your personal tax return as a small business owner. And so that's the number that you'll want to, that's the number I'm sure you've heard most of. Now, below the net income number is typically another list of expenses, whether an income, right? So you've got some other income items here, and these are things, other sources of income you receive that are not primary revenue, right? So like credit card rewards, right? I think that's become more and more popular these days with all the different types of rewards that are out there, being able to redeem rewards for different, purchases of different items, or also being able to just get cash back rewards, right? Getting credits on your credit card statements. And so that's where these amounts should be booked, is in your other income under credit card rewards. Insurance claims, interest earned, sale of an asset, all of these things drop below that first net income line, because these things are all treated a little bit differently on your tax return. So it's important for your tax professional to be able to easily identify what if you had any of this activity in your business, where to be able to find that, to know that this is not going to be treated as a normal expense or normal income. It's different. It's handled a little bit differently on your tax return. And so that's where those come into play. And other expenses are going to be things that are not going to necessarily be deductible to you on your business return. QuickBooks has been kind enough to put this in here so that we could track it for our small business owners. I personally don't track home office expenses in my clients' QuickBooks files, because I think it just kind of skews things a little bit, especially when it comes to your draws. It can kind of overinflate your draws, which we'll have that conversation in another training, because that would get us really deep into what you should and shouldn't be including in your business finances, like as far as taking money out of the company, and how running too many of your personal expenses through the business, how that could be actually really detrimental to you come tax time. So we'll have another conversation about that at a different time. But just keep in mind that, QuickBooks does offer that. If that's something that you do want to do, is track all your home office expenses in your books, that you can do that here. You just want to make sure that you've discussed it with your bookkeeper and your tax professional to make sure that they agree that this is how it's going to be tracked. So, all right. So I think that kind of wraps up the Accounting 101. We'll be doing another live training here in the next couple weeks. I think the next live training we're going to do, though, is going to be done via Zoom instead of Facebook Live, just because I feel like the Facebook Live interface maybe just may not be the most user-friendly for folks to, especially for us to try to share screens and things like that. So I think next training session we'll be doing it via Zoom link. Please keep an eye on your email and subscribe to our social media for those announcements. And whoever came to join, thank you so much. Y'all have a great day. Bye-bye.